two specific techniques that would help us define the change strategy. So one is the BCG growth or share portfolio matrix. So it is about how attractive the market is for your product, for your business unit, or for your entity, or for your process. Typically, it is used mainly for product portfolio. If you've got a portfolio of 10 different products, how would you be able to prioritize and optimize which one do you need to invest more, and which one is something that you can actually kind of divest or stop producing, and which one is something that you can continue your investment at some stable level. So that's what you get to optimize your portfolio mix, as what we call, from the BCG. And then the GE business screen matrix is also the similar tool. It would help you identify what is the most attractive market in terms of your product offering, product or service offering. So we will look into each of these in detail now. So as we discussed, it would help in identifying the priority areas for your portfolio management. If you've got like 10 different products, services, offerings, how are you going to invest? How are you going to, you've got the portfolio pot in which you have got some money. How would you actually distribute your investment across your product offerings or your business units or entities? So that's what this particular tool is really helpful for. It would, for that, basically what you need to start with is to identify all the business areas, all the business units, teams or whatever it is that you have got in your organization. And then you need to, across two different axes, we'll have to identify what is the market share for that particular product. What is your current market share? Do you have a lion's share at the moment, or is it a small minuscule? So in terms of the growth rate is what you actually plot on the y-axis in terms of the potential for growth in that particular market segment for each of those products. And then what you would do is you would plot your particular products, and accordingly to the basic how the positioned, you can determine whether that particular product is a star, a question mark, a cash cow, or a dog. I think this you would have done in your MBA, but pretty much what we have done there is what we will try and learn here. So this is what is the BCG. It was developed by BCG, which is a consulting firm. So Boston Consulting Group. So it got the name from there. And what it does, as I mentioned, is basically the relative position or the market share is plotted on the x-axis, and the potential, basically what is the potential growth rate that this particular product offering or service has. So we will try and map it on here on the y-axis. And then if your products or offerings are around in this particular area, this quadrant, you'll call them as stars. So what you do is basically they are basically, as the name suggests, they're performing well. There is a high potential for growth rate. The market share is really good. That's very high, which means that they have got a fantastic potential and high performance, hyper as what we call high potential, high performance. So in which case you try and continue the investment to that. Cash cows, on the other hand, is basically the growth rate for that is kind of stagnated over a period of time. But then the market share, you still are the leader in that segment, perhaps. For example, you can try and kind of milk the cash from that, milk the cash cow, so that you can continue getting the returns and benefits from this without investing too much into the product development. So this is where you would typically try and move into the stars. Basically, you would push basically these cash cows under the stars in terms of how they're placed. And then there's these dogs, which they call. Dogs are basically those units which must be shelved. Unfortunately, I don't like the term dogs. I'm not a great lover of punishing dogs. But basically what they're talking about is if you've got a very low market share and the growth rate is not that optimal, you can just kind of divest in that. There's no point keeping invested into those product segments and product offerings or services. So for example, if in the context of digital technologies that we have now, if you've got a print business, for example, with a huge setup of manufacturing, a huge production plant, a lot of raw materials lying out there in terms of paper, the pulp, you've got suppliers who do this, all these things. And in the context of that, what is the growth rate? What is the potential for paper in this context? And the print is dying out. I'm not sure if you've heard about this story. I just came to hear this story yesterday. I read this post about IKEA discontinuing their famous catalog. It was there for a good, I think, 70 years. They've been publishing the IKEA catalog, product catalog. It's a printed book of all the IKEA's product range. Every year they publish IKEA's new.
So IKEA is stopping it?
Yeah, it's stopping it. It's stopping it for the first time after such a long time. Apparently, that is rated as the biggest published book after Bible and one more thing, Harry Potter books.
Wow, I didn't know that.
Yeah. Surprised actually. So apparently, it is supposed to be.
Argos did the same few years ago, but Argos is not that as big as.
Yeah, Argos is still big, and in terms of UK market, definitely they've got that. But apparently, IKEA has got this book publishing going on for the last 70 years in about 45 different languages. I was zapped. 45 different languages. And imagine across so many countries. Imagine the volumes of the books that they publish, or this so-called catalogs that they've been publishing over the last so many years. And this is like every year they bring out new one. It's not like, for example, I'm just quoting it out of for no reason, but Bible, I mean, you have got new versions. For example, you've got Old Testament, New Testament, and then you don't have doesn't get updated every year. But this one has got more and more pages, more and more content being added, and it become so bulky. Now it's almost this big, I've seen. And they published that for I think the last published IKEA catalog they were saying was in April or May this year, summer. That's it. After that, they stopped. They're not going to produce it. So, I mean, I'm glad at least they realize that it is now we're in the digital age. There's no point of just publishing and creating so much of paper and print material, which you're ultimately going to just go down the gutters. So that's only adding to the environmental problems later. So that's a dog there, definitely. So they've decided that we're ditching this. We're not going to continue with this one anymore. So that's exactly kind of decision that we need to do as business that we would need to make. And then what comes up is basically the question mark. This is the kind of products or offerings here where you've got a very low market share, but then potentially there's a huge market growth rate. So there's a potential for that, but then the what we have out here is very low in terms of the market share. So that's where you could see that there is definitely a lot of scope for these businesses to be investing in going to multiple geographies, different markets, and things like that. But they do not have. But what needs to be done in that case is basically you still need to pump in money into this segment. Whereas dogs, there's definitely no way for you to kind of keep pumping in the money. You need to divest here. Cash cows, keep doing something, a small little investment, keep it going, but get more benefit out of it. Stars are basically where you need to pump in more money, and there's a lot of potential. So the return from the investment would come in much later, but it's certainly a promising one. Question marks, on the other hand, is not as promising, and then that's where you need to really think whether you can move these products from here to here or from here to here. That's the whole strategy. So very, very useful tool in terms of if you've got a product portfolio kind of thing. That's what you would like to use this BCG matrix, the portfolio matrix. Now talking about GE-McKinsey's business screen matrix, again, very similar in terms of the approach, the business portfolio. It would help understand the attractiveness of the industry for each of the business unit. That's the key potential for this technique or tool. So what we do here is basically we consider the drivers. So what are the drivers? The market size is definitely important. How big the market is in terms of the size, whether it is in terms of the number of units that we can sell, or the revenue potential, all of that. And then the market growth rate. What is the potential for the market to grow in the next year, 2 years, 5 years? And then how is the important dimension that this GE-McKinsey tool has over the BCG is adding another dimension of the external one, which is the competition. So how is the competition faring? What is the competition really like? If there's a lot of competition, if it's really kind of congested marketplace, then there's no point actually trying to invest, even though it is attractive. So you need to really consider all the different variables, different dimensions. And then of course the other thing is to also look at the availability of the resources as well. Do we have the resources? It's again looking inward, isn't it? So like for example, the SWOT, looking at the strengths, weaknesses, which are inward, internal, and the opportunities and threats are going to be external, so which is looking at outside work. So the risks and returns, again, we were discussing this about risk assessment yesterday, talking about how much of importance it is to identify the risks, the potential that they are going to likely to happen, what's the impact that they're going to create on the initiative that we have, and what is the likely profitability of this, of whatever we're trying to do. So how profitable is it going to be? Is it going to really return a lot of the return on investment? Is it going to be significantly higher, or is it going to be like, oh no, it's just about, it will take 5 years to break even, then there's no point? So all of these are important within that context of the industry attractiveness, as what we were defining. So this is pretty much how it really looks at. So we've got the business unit strength, business strength, the business unit strength of each of the business unit. That's considered on one aspect, and that's the y-axis. And then what we plot on the x-axis is basically what we call the industry attractiveness. How attractive is this industry? For example, if you're talking about the travel industry, for example, now in the current context of the lockdown and the virus and the havoc it created, obviously with all the pandemic around, travel has been curtailed. Look at travel industry, airlines, tourism, ticketing, air ticketing, and then all of these allied industries, everything around this, and then the industry supplying food to the airlines and the and also all these are kind of trains, whatever these companies would be, all the businesses which are in that catering business, for example, they have a significant impact. So if you talk about that attractiveness at the moment, it's going down. So you need to consider that. Very, very important. So what is really strong and what is really attractive at the moment now is those businesses who are heavily invested in technologies, in digital technologies, for instance, those products or services offerings which have got significant relation to remote working, teleworking, and online and virtual trainings and online stuff. They've got significant boost, obviously. And then you've got healthcare, life sciences, these kind of companies which invest into the diagnostics, and then the pharma and therapeutics and the healthcare. They've got, again, a significant attractive kind of quotient at considering the time that we are now in. So that's how you can consider. So what do you need to do? You need to look at the aspects of production capacity. If you really want to understand the strength of the business, what is a current production capacity? What's the market share that we have now? What's a goodwill? What is a brand equity? And then what is the customer loyalty? Obviously, all of these are going to talk about how we are being perceived in the market, how we are perceived as a player in the market, right? And then we need to look at management, the product quality, innovation, all those different factors. Considering all these different aspects, we can try and see how strong we are as a business, right? And then for each of these drivers, what we need to come up with is the relative importance, how important that is, considering the current context. And then we would need to give points, which again is a relative set of points. You can have like 1 to 10, low, medium, high, whatever it is. And then multiply relative weights and points, and then you come up with a graph to say where it is. So if your business unit is here, or your kind of entity is somewhere here, which means that it has got very high industry attractiveness, but then the strength of the business is low, which means that you need to kind of selective investment. Either you want to pump money into it, or you need to get out of it. There are only two options there. It depends on your strategy again. And then if you really want to, for example, If the attractiveness is very low, there's no point actually, industry, for example, you're talking about travel industry, and then we have been pumping money into this business for the last 10 years, still it has not taken off. On the top of it, you've already suffered significant investments. There was no return from this business of travel or tourism that you set up. And then on the top of it, the current outlook of this travel industry is really low. It has gone really negative. In that case, what's the point of keeping on investing and pumping more money into that? So obviously the strategy for you is that to consider. I mean, we're not saying that this has to be for every travel company, but what we're saying is, if you see that there is a very bad outlook from the market point of view, and then you have not been really strong in that, then what is the point? Just exit that and then come out of it. And then same with for example, the exact opposite of that is basically, if there's a very high attraction in the market, and then you've got really strong presence there. So what does that mean? You've got to grow, you've got to put more money, get more people into that, expand your market, expand to further geographies. And that's where all these medical and healthcare companies have been doing now, because they have realized that there is a huge potential for them. And then all these years they've been significantly investing. They've got really nice products and offerings there. So which means that this business strength is very high, and so is the market attractiveness, which means there's a likelihood that they'll, whatever, for example, if they apply for a patent, they'll immediately get it. If they apply for funding, they'll get immediately, because there is huge drive for these kind of initiatives and products in the market. So that, and so also the same with other aspects of the quadrants here as well. It's similar to the other BCG portfolio matrix, but here we're talking about industry attractiveness as well, and slightly different in terms of, you've got more scales here, low, medium, high, and you've got more prescriptive way of what you can do here, whereas there it's just about 4 prescriptive opportunities or options that you have. So this is again another use